How you doing, Value Hounds? I'm so excited to be talking to you right now because you're going to learn from one of my lessons. I made a mistake, and it wasn't a big mistake, but it was a mistake that cost me some money. So when I got started in syndication, I got started back in 1991. And in 1991, they had the big savings and loan crisis. And during the savings and loan crisis, there was a lot of savings and loans that were lending to real estate projects. That was a problem. They changed the tax laws and allowed that to happen. That caused a big problem, caused a lot of foreclosures, caused the RTC to be formed to help dispose of these assets. So I thought, I'm in Southern California, I'm in the brokerage, and I'm also in the management business. And I thought this is a great time for me to get into syndication because there's a great buying opportunities in these marketplaces. I looked around the marketplaces. I thought about Houston, 6,000 a door out there, but then I said that's a 3.5 hour, 4 hour flight from Southern California, so that's just too far for me to go. So I found Phoenix. It's an hour drive. It's a 6 hour drive. It's an hour flight, and I thought, okay, let's go check this out. So back in 1991, I took a trip just to inspect and investigate and find out what's going on. And I found out that it was a great little market. It had probably 17-18% vacancy. They weren't building much anymore because there was no demand. So the absorption was going to start to pick up, and I thought, okay, this is a good market to be in. I went out and inspected the marketplace and trying to find where's a good place to set up shop and pick a place to start buying. What I found was that the Class C properties, the areas on the more of the west side, were selling for about $15,000 a unit at about maybe 8 cap rates. And I also found that the B class properties more on the east side were selling for more like 22,000 a unit at about 7 cap rates. So I'm thinking, I can buy $15,000 a door versus $22,000 a door, and I'm thinking, man, I'm going to make more money if I do it $15,000 a unit. Whereas in California, they're selling for over $100,000 a unit. So I'm thinking, wow, that's a pretty good price. I'm going to make a lot of money. This is going to be a winner all the way around. And what I found out was I was wrong. Yeah, I was wrong. So what happened was, what I learned was in the B class markets, the better markets, the rents went up higher, they went up faster, and they went up quicker, right, than my C class markets. I'm struggling a little bit where this market started to turn. They're getting absorption and they're filling their vacancies, they're raising their rents, they're raising them nice and high. And so I learned that lesson. Just from a rent standpoint, those better markets, they go up faster, they go up quicker, they go up higher. So that's a huge benefit. Our markets were a little bit slower. We decided that after about 6 years, we're going to sell our properties. So we sold our properties, and when we sold our properties, we sold them for about 22,000 a unit, 21,000 a unit, somewhere in that range. We sold them at 7 cap rates, a little higher cap rates than the B market. But what I learned was the B markets, the better markets, sold for about $42,000 a unit at 6.5 to 7 cap rates. Think about that. There's a big difference of value appreciation there, just in those numbers. And we missed that opportunity. But not again. I want you guys to learn that you need to buy in good markets. Now, there's a lot of repositioning markets that are in transition that you can buy into, but make sure that those markets are getting stronger. There's a growth going on in those markets to help more buyers come in and push up values. So I hope that serves you. I hope you got some good information. Buy in better markets. For more information, go to valuehoundacademy.com. That's valuehoundacademy.com. I've got tons of information about this and other things that you can get for free. It's a great resource for you.